We all have this basic idea in our heads about investing, right?
Hmm.
Higher risk, higher potential reward. It's pretty much what they teach in business school.
Yeah, standard stuff.
Even textbooks, like Greenblatt and Titman, they point out how betting on the future, those growth opportunities, feels inherently riskier.
Hmm.
They tend to do well when things are booming and can really, well, take a hit when they're not.
That makes intuitive sense, definitely. Companies chasing big growth, they're often more dependent on, things going their way down the line.
Right.
Meanwhile, value companies, the ones with a lot of their worth tied up in what they already own, they seem like the safer bet, less likely to have those dramatic ups and downs.
Yeah, feels more stable.
In fact, some research has even suggested that these growth bets are almost like placing a leveraged bet on the company's existing foundation, like an option almost.
Okay, but here's the twist, the bit that really makes you stop and think. Despite this logical picture, history keeps showing us something different. It's called the value premium.
Ah, yes, the big puzzle.
Year after year, those seemingly more stable value stocks, the ones with high book-to-market ratios, they tend to deliver better returns than those exciting growth stocks, the ones with low book-to-market ratios. It's a puzzle, isn't it?
It really is.
If growth is supposed to be so risky, why aren't those stocks the ones paying off more in the long run?
It is a genuine head scratcher, often called the value anomaly, like you said. And for a long time, the explanations mostly focused on how investors behave.
Right, like we get carried away.
Exactly. Maybe we get too excited about growth companies, push their prices too high, and then, well, end up with lower returns later.
Yeah.
Behavioral finance stuff.
Okay,
But today, we're looking at a different angle entirely, a different kind of explanation.
exactly. Let's forget the idea of investors making mistakes for a moment. We're diving into a fascinating piece of research that offers a completely rational reason why this might be happening.
Based on economic.
Right. This paper uses a fundamental economic approach based on the idea that markets, by and large, work logically, based on rational expectations. Our goal today is to see how this framework can argue that value stocks might actually carry more risk than growth stocks.
Which sounds totally backward at first.
It does. But if they are riskier, well, that's why they offer that extra return. It solves the puzzle.
What's particularly insightful here, I think, is that this research focuses on two key economic realities. First, that it's often harder and more expensive for companies to shrink their operations than it is to grow them,
Okay.
what they call costly reversibility.
Costly reversibility, got it.
And second, that the reward investors demand for taking on risk tends to go up during tough economic times, when things feel uncertain.
A counter-cyclical price of risk.
Precisely. And these ideas really challenge how we typically think about what makes a company risky.
Okay, so let's just circle back to this central puzzle one more time to make sure we're clear. Growth stocks, those forward-looking companies, seem like they should be the risky ones.
Yeah, betting on the future.
Their success depends on future events, which are inherently uncertain. There's this built-in leverage, almost, as you mentioned.
Right.
Yet, the historical returns tell us a different story. Those steady value stocks have actually outperformed over long periods. It feels backward.
It does. And that's why this research, which takes a more fundamental economic perspective, is so compelling instead of just focusing on investor psychology.
Which is interesting, but maybe not the whole story.
Maybe not. This approach looks at the basic principles of how businesses operate and how markets, rationally price risk. The aim isn't to say markets are perfect all the time, obviously not.
No, of course.
But to understand what a rational market would imply about the risk and return of these different types of companies. By starting with these core economic ideas, the paper builds a really clear, logical argument.
Okay, so this paper steps into this rational world and arrives at a, well, pretty counterintuitive conclusion. The very assets that define value stocks, their existing physical capital, their factories, their stuff.
Their assets in play.
Right, those are actually riskier than the future possibilities, the growth options that drive growth stocks. And this risk becomes especially apparent when the economy takes a downturn, those bad times when, as we'll discuss more, the price of risk that compensation investors demand goes up.
Precisely. This is the absolute core of their thinking. They're suggesting that the stability we often associate with value stocks, those tangible assets, can actually become a major vulnerability under certain economic pressures.
Okay.
And if this is true, then the higher returns we see from value stocks aren't an anomaly at all. They're just the logical compensation for holding a riskier type of investment, particularly risky in those bad times.
So how does the paper get to this seemingly upside-down idea that owning physical assets can be riskier than betting on future growth?
Yeah.
This is where this concept of costly reversibility comes in, right? Can you break that down for us in a practical way?
Sure. Think of it like this. Imagine a company that needs to cut back, needs to shrink. A tech startup that was planning a new product line, well, they can probably just scrap the project relatively easily, write off some R&D, maybe let a few people go. It's not painless, but
Manageable.
manageable often. But contrast that with a big manufacturing plant with lots of specialized machinery. If demand for their product just collapses,
Yeah.
they can't just sell off that giant custom machine at full price overnight or instantly repurpose the whole factory for something else.
Right, it's stuck there.
They might have to sell equipment for pennies on the dollar, lay off highly skilled workers they might need later, maybe even shut down a whole facility. These are all really costly ways to reduce their operations. That's the costly part of costly reversibility.
Okay, that makes sense. It's harder to undo investment than to make it.
Generally, yes. On the flip side, when things are good, expanding by hiring more people or buying standard equipment is usually less painful financially, less friction.
That makes a lot of sense. So how does this difference in the ease of scaling up versus the difficulty of scaling down affect value and growth companies when the economy hits a rough patch?
Well, in a downturn, value companies, which by definition have a lot of their money tied up in existing factories, equipment, and so on.
Assets in place.
Right. They might suddenly find a lot of that capital isn't generating much revenue. Demand for their products or services might fall sharply.
Okay.
Now, if they want to shrink their operations to match this new lower demand reality, they run smack into those high costs of disinvestment we just talked about.
That's stuck.
They're somewhat stuck with assets that aren't pulling their weight, maybe even losing money, and their profits take a bigger hit as a result. Their stock returns become much more sensitive to the bad economic news. They have higher operating leverage in a way.
Okay, that's the value side. And what about those growth companies when times get tough? They're often focused on future projects, right? Not so much on huge physical plants right now.
Exactly. Growth firms, typically with fewer current tangible assets relative to their market value, don't have the same kind of pressure to drastically shrink their physical operations.
So they're more nimble.
In that specific sense, yes. They might postpone new investments, slow down hiring, maybe cut R&D budgets. That's often less immediately damaging, less costly than trying to unwind existing large-scale infrastructure.
Okay.
Now, flip it to when the economy is booming. Growth companies will be eager to invest more to take advantage of the opportunities. And while there are costs to expanding, the research suggests these are generally lower or easier to manage than the costs of shrinking.
And value firms in good times.
Value companies whose existing assets are now humming along don't necessarily need to make huge new investments as urgently. They might optimize, maybe expand moderately, but because expanding is generally easier for everyone, the returns of growth companies don't necessarily skyrocket disproportionately during booms.
Oh,
While value companies might see a more steady but perhaps less explosive improvement as their existing assets work harder.
So, this imbalance in how easily they can adjust the costly reversibility means that value companies feel more of the downside pain in bad times, but maybe don't capture all the potential upside in good times relative to growth. It's asymmetric.
That's the core idea. It's this difference in their sensitivity to the economic cycle, driven by the asymmetry in adjustment costs, that creates a risk difference between value and growth, especially when things go south.
Okay.
Precisely. The paper argues this leads to a bigger gap in risk between value and growth, specifically during economic downturns. And interestingly, in good times, that risk gap might be much smaller, or even disappear, or maybe even slightly reverse.
So if you just average it out over time.
Right, because bad times tend to be less frequent, maybe shorter, than good times. The overall long-term risk difference between value and growth might seem relatively small if you just look at simple average measures like unconditional beta.
But it's there when it counts.
That's the argument. And other research, like Petkova and Zhang's work, does suggest that if you look over longer time periods or use more sophisticated measures, that higher risk for value stocks does show up, even unconditionally.
Okay, so we have this idea that value stocks might be riskier when the economy struggles because it's hard, it's costly for them to downsize. But the paper also talks about a counter-cyclical price of risk. What does that mean in plain English, and how does it make this whole picture even clearer?
Okay, the price of risk is simply the extra return investors demand for holding investments that they perceive as being riskier, the risk premium.
Right, the compensation for bearing risk.
Exactly. Countercyclical just means it moves in the opposite direction of the economic cycle.
So up when the economy's down, down when it's up.
You got it. A countercyclical price of risk means that investors demand a higher premium for taking on risk during bad economic times, recessions, downturns, and they're more willing to accept lower premiums during good times, during booms.
And that makes intuitive sense, right, when everyone's nervous.
Totally. When there's a lot of uncertainty, maybe your job feels less secure, the future looks cloudy, investors naturally become more cautious, more risk-averse. They want to be compensated more for putting their money at stake in anything remotely risky.
Okay.
The model in the paper explicitly includes this idea, suggesting that the rate at which we discount future cash flows, which is effectively our required rate of return, or the price of risk is higher when the overall economic outlook is gloomy.
So how does this higher demand for risk compensation during bad times, how does that amplify the effect of this costly reversibility thing we were just talking about?
Well, it creates a kind of reinforcing cycle or maybe a double whammy for value firms in bad times.
Okay.
Because investors are demanding higher returns overall in bad times due to that increased uncertainty, companies, especially those value companies, stuck with potentially underperforming assets because of costly reversibility. They have an even greater incentive on paper to try and shrink their operations.
Because the hurdle rate is higher.
Exactly. The discount rate applied to their future, possibly weaker, cash flows is higher, making those assets look even less attractive. So rationally, they should want to disinvest even more aggressively.
But they can't easily because...
Because of that costly reversibility. It's difficult and expensive for them to actually do it. So this inability to adapt quickly to both the negative economic shock and the higher required return, the higher price of risk.
makes them look even riskier.
It makes them look even riskier to investors at precisely the time investors are most sensitive to risk. And that further justifies the higher expected returns, the value premium they tend to offer.
Wow. It's like a perfect storm for value stocks in a recession then. Their core assets become less productive. They're sort of trapped with them because selling them off or shutting them down is too costly. And at the exact same time, investors are shouting, hey, we need to be paid even more to hold on to these suddenly very risky assets.
That captures it perfectly. And the paper actually provides a kind of simple conceptual equation for this. The value premium equals the risk difference between value and growth multiplied by the price of risk.
Okay. Risk dispersion times price of risk.
Right. So even if the underlying risk difference, the dispersion between value and growth, stayed exactly the same across the economic cycle, which the model says it doesn't.
Right. It widens in bad times.
It widens in bad times. But even if it stayed the same, just having a price of risk that goes up in bad times would naturally lead to a higher value premium during those bad times.
Makes sense.
But because costly reversibility also increases that risk difference specifically in bad times, the impact on the value premium is amplified. It's like multiplying two things together that both get bigger in bad times.
Gotcha. Okay, so this model, built on these pretty intuitive ideas, really costly reversibility and a price of risk that changes with the economic climate, gives us a rational story for why value stocks might be riskier and thus have higher expected returns. But does this model just explain this one thing, the value premium, or does it also fit with other things we've observed in the stock market, other empirical regularities?
Yeah, that's a great question. And what's really powerful about this kind of structural economic approach is how it often provides a consistent way of understanding several other patterns we see in stock returns, all related to this value premium idea.
Like what?
Well, for example, we've known for a while observationally that value stocks tend to be more volatile or have higher betas than growth stocks, especially when the economy is struggling.
Right, riskier in bad times.
Exactly. This research, and it lines up with findings from folks like Letow and Ludvigsen and Petkova and Zhang, fits perfectly with the model's core mechanism, that value companies are less flexible, more exposed during downturns due to costly reversibility.
Okay, that fits. And what about how profitable these companies are? We often see that companies with high book-to-market ratios, the value stocks, tend to have lower profitability, maybe lower growth, and the opposite is true for growth stocks.
The model helps explain this too, naturally. Fama and French pointed this out years ago. A high book-to-market ratio often indicates a history of lower profits or maybe some distress, while a low book-to-market often suggests higher past or expected profits and growth.
So it's not just random.
No, and in this economic framework, a company's underlying efficiency and productivity, which is kind of analogous to profitability, is what fundamentally drives this. The model actually shows, when they simulate it, that companies that end up being classified as growth are indeed the more productive, more profitable ones leading up to that classification,
Okay.
while the companies classified as value have tended to be the less productive, less profitable ones. So this difference in their fundamental performance is what rationally sorts them into those value and growth buckets in the first place. It's endogenous.
That's a neat link.
Oh.
Okay. And we also see empirically that the expected value premium, the extra return you anticipate getting from value stocks over growth, seems to be bigger when the difference in book-to-market ratios between value and growth stocks is itself large. Does the model account for that?
Absolutely. Researchers like Cohen, Polk, and Voltinaho have documented this pattern. They call that book-to-market difference the value spread, and they find that the expected value premium and this value spread tend to move together over the economic cycle.
They're both countercyclical.
Exactly. The model illustrates this very point quite clearly in its simulations. Both the expected extra return from value stocks, the expected premium, and the difference in book-to-market ratios between the less productive value-like firms and the more productive growth-like firms tend to widen during times when the overall economy isn't doing well.
Okay.
Those bad times where risk is priced higher and value companies are really feeling the pinch of costly reversibility. It all
Yeah.
hangs together.
Interesting. And there's also some evidence, I think Asmus and his colleagues found this, that how much faster or slower the earnings of value companies grow compared to growth companies can actually predict future value minus growth returns. How does that piece fit in?
Yeah, that's another interesting empirical finding. While the precise mechanics of predicting returns using earnings growth within the model are quite detailed,
Yep.
the broader idea is that because the model directly links a company's fundamental productivity and its investment decisions to its expected stock returns, it provides a coherent framework for understanding why changes in these underlying fundamental factors, like earnings growth differences, could indeed tell us something useful about future stock performance, including the future value premium. It's all driven by the underlying economics in the model.
So the model doesn't just explain what we've already seen, things we already knew.
Yeah.
It also points to new things we could potentially test or look for.
Yeah.
That's often a sign of a really useful theory, right? What new predictions does it make?
Definitely. This is where the research really opens up interesting avenues for future empirical work. First, it makes a very direct prediction. Value companies should indeed be disinvesting more or investing less than growth companies during economic downturns, while growth companies should be investing relatively more when the economy is strong. You should see this in the actual investment data.
Okay, a testable implication about investment behavior.
Right. Second, it reinforces that idea we discussed earlier, but makes it a concrete prediction. Both the expected value premium and the value spread, the book-to-market difference, should be countercyclical. They should widen when the economy contracts and narrow when it expands.
Another clear prediction.
Third, and this is quite interesting, it suggests that if you look across different industries, the degree of that asymmetry in adjustment costs how much harder it is to shrink operations compared to expanding them in that specific industry should be positively correlated with the average expected value premium you observe in that industry.
That makes sense. So industries with really specialized equipment that's hard to resell or repurpose, maybe like, I don't know, specialized manufacturing or mining, might show a bigger value effect than industries where capital is more generic.
Exactly. That's the prediction. Fourth, the model predicts that the expected return for investing in a particular industry as a whole, the industry cost of capital, should be higher if that industry, on average, has a higher overall book-to-market ratio.
Okay.
And also if there's a wider dispersion, a wider range of individual stock returns within that industry. This connects to some previous findings by others about the relationship between aggregate volatility and market returns.
Right, like Goyle and Santa Clara's work.
Precisely.
Yeah.
And finally, related to that third point about industry differences, the model suggests that the degree of that cost asymmetry, how much harder it is to downsize versus grow in an industry, should also be positively linked to the overall expected return, the cost of capital in that industry. More asymmetry, higher cost of capital.
Wow. Okay. So quite a few new things to look for in the data. Now, this fundamental economic approach offers a very different perspective on the value premium compared to some other existing rational theories. How does it really stack up against that model by Gomes, Kogan, and Zhang that we sort of touched on at the beginning, the one that also tried to explain it rationally?
Yeah, that's an important comparison to make. Their model was also influential, looking at how company characteristics like size and book to market relate to risk and return within a rational framework. But their explanation for the value premium relied quite heavily on a key and perhaps problematic assumption.
Which was?
They assumed that all companies essentially have the same underlying growth opportunities available to them.
Okay. That seems strong.
It is a strong assumption, and it led to a somewhat counterintuitive implication in their model, that the more profitable growth companies would actually have to pay out more dividends and therefore have shorter cash flow durations than the less profitable value companies.
Growth companies paying out more dividends? That doesn't sound right.
Exactly. Real-world data from folks like Smith and Watts or Decho, Sloan, and Solomon actually suggests the opposite is true. Empirically, growth companies tend to reinvest more, pay out fewer dividends, and often have longer equity durations than value companies.
So that key assumption in their model doesn't really line up with what we actually see companies doing in the real world.
Pretty much. It seems counterfactual. So by not making that restrictive equal growth opportunities assumption, the model we're focusing on today allows companies to make their investment decisions based on their own specific productivity levels and the economic circumstances they face.
Which feels more realistic.
It feels more realistic. And this leads to a fundamentally different explanation for the value premium one, where it's the costly reversibility combined with the changing price of risk that makes those existing assets of value companies inherently riskier, especially in bad times. This newer model seems to do a better job of explaining the various empirical patterns we observe without relying on assumptions that clash with actual observed company behavior regarding investment and payout policies. It links productivity, investment, and the premium endogenously.
And this model also has implications for people who try to time their investments, right? Deciding when to favor value stocks over growth stocks, a strategy sometimes called style timing.
Yes, absolutely. While the model is primarily about explaining the average premium, its mechanics can help us understand when we might expect value stocks to do better or worse relative to growth stocks. The simulations within the paper suggest that the value spread, that difference in book-to-market ratios we talked about, is actually a pretty good indicator of the future value premium, especially if you're looking over longer horizons, like a year or more.
So when the spread is wide, expect higher future value returns.
That's what the model predicts, consistent with some empirical findings. The difference in earnings growth between value and growth companies also seems to have some predictive power in the model simulations, which again aligns with what some practitioners and researchers like Asness have found.
And does it say anything about when the premium should be highest?
Yes, consistent with the whole mechanism, the model predicts that the expected outperformance of value stocks relative to growth stocks should be greater during economic downturns when that price of risk is high, and costly reversibility bites hardest.
Okay. We also briefly mentioned the cost of capital at the industry level earlier. The model has something specific to say about predicting that as well, right?
That's correct. It's not just about the value minus growth return. The model indicates that the expected return investors demand for investing in a particular industry, which is essentially its cost of capital, should be somewhat predictable.
Based on what?
Based on things like the average book-to-market ratio of companies within that industry, and also the value spread within that industry, the difference between high and low book-to-market firms in that sector. This fits, again, with some real-world evidence suggesting that industries with higher average book-to-market ratios tend to have higher future returns on average.
So to wrap up our deep dive today, it really seems this research provides a really compelling and importantly rational explanation for this long-standing puzzle of the value premium.
I think so. It's a strong contender.
Instead of just saying it's all about investors overreacting or making behavioral mistakes, which might still play a role. Of course, this model shows how fundamental economic forces,
Real frictions in how businesses operate.
exactly, the difficulty of shrinking a business, that costly reversibility combined with changing demand for risk compensation, the counter-cyclical price of risk.
Yeah.
How those two things interacting can naturally lead to value stocks being riskier, especially when the economy is struggling.
And therefore deserving.
And therefore deserving of those higher long-term returns we've seen historically.
That's the key insight, I think. By grounding our understanding of asset prices in these basic economic principles, like how companies actually make investment decisions under constraints and how rational investors think about risk across the business cycle, we can start to make sense of market behavior that might seem strange or anomalous at first glance.
Yeah.
And the fact that this single coherent framework can also explain, or is at least consistent with, so many other related empirical patterns and point us towards new testable predictions, that really highlights the value of this kind of fundamental, micro-founded structural approach to understanding how financial markets work.
It definitely gives you a new way to think about those quote-unquote boring value stocks, doesn't it? Maybe not so boring, just differently risky.
Perhaps riskier when it matters most.
Right. Now, while this model provides a really insightful and, frankly, quite logical explanation based on these real-world technological frictions and how businesses can adapt, you can't help but wonder, as a final thought perhaps, how other real-world factors, maybe things not explicitly in this specific model, like, say, financial constraints, how easy it is for companies to borrow money, or even the actual raw risk of going bankrupt, how those might interact with this story or play an even bigger role in shaping the value premium we observe out there.
That's a great point. This model focuses on the investment technology side, but financial frictions are undoubtedly important too.
It feels like this conversation between rational economic explanations and behavioral insights in finance is definitely going to continue for a long time, and there's still so much to learn and explore. If you, the listener, are curious to explore this further, we highly recommend checking out the research we've discussed today, the paper by Zhang and his colleagues, and maybe diving into the ongoing debate in this really fascinating area of finance.